Why does the exact same vacation cost more some years than others? And how can one country owe $40 trillion and be totally fine, while another owes a fraction of that and collapses? Part 2, I'm going to draw how the whole world's money is wired together: currencies, trade, and debt, with nothing but stick figures. Welcome back to Stick Market. Quick disclaimer as always: this is not financial advice. I'm a stick figure with a marker. In part 1, we built the economy inside one country: the circular flow, inflation, central banks, GDP, the works. If you missed it, the full part 1 is linked right down in the description. But here's the thing: no country lives alone. They trade, they lend, they invest in each other. So today we zoom all the way out to the global economy. Let's start where every cross-border story begins: the exchange rate. An exchange rate is just how much one country's money is worth in another country's money. That's it. If $1 gets you about 9/10 of a euro, that's the exchange rate. And it's constantly moving. Say a dollar buys 9/10 of a euro today, but tomorrow it only buys 8/10. The dollar just got weaker. Your same dollar buys fewer euros than it did yesterday. Flip it around, and the dollar got stronger. One little number, two directions. And that number quietly touches your life. It sets the price of anything imported: your phone, your car, your coffee beans. It decides what your vacation abroad costs. Here's the trick most people miss: when your currency gets weaker, foreign stuff gets more expensive for you, but your country's products get cheaper for everyone else, which can be great for exporters. A weak currency isn't simply bad, it's a trade-off. Somebody always wins on each side of the move. So what actually moves them? The same thing that moves everything else: supply and demand. If lots of people want a country's money, its value climbs. If they don't, it falls. Picture a fast-growing country. Investors all over the world want to buy in, but first they need that country's currency. So demand jumps, and the currency strengthens. Now flip it: a country with high inflation or political chaos. Investors get nervous and pull out. Demand dries up, and the currency sinks. Money flows toward confidence and away from fear. Countries handle their currency in two main ways. Most big ones: the dollar, the euro, float. The market sets the value, and it bobs up and down every second. But some countries fix, or peg, their currency. They pick a target value, usually against the dollar, and the central bank fights to hold it there. A peg can feel nice and stable, but it's expensive because the moment the market disagrees, the central bank has to step in and defend it. Which brings us to the war chest they defend it with. Every central bank keeps a stash called foreign reserves: piles of foreign currencies, gold, and other countries' government bonds. Think of it as the nation's emergency savings account. If their own currency is falling too fast, they can dip into that stash, selling dollars to buy back their own money and prop it up. But there's a catch worth knowing. There's gross reserves, the total pile, and net reserves, the pile minus what they already owe to foreigners soon. So a country can brag about 100 billion in reserves, but if it owes 60 billion shortly, the truly usable cushion is only 40. Always look at the net number. Okay, trade. Why do countries even bother? Imagine country A is brilliant at building cars, and country B has the perfect climate for growing coffee. A sells cars to B, B sells coffee to A. Both end up with cars and coffee, cheaper and better than if each tried to do everything itself. That's the whole point of trade. Everyone does what they're best at, and the whole world gets more for less. Now keep score. A country's trade balance is simply exports minus imports. Sell more to the world than you buy from it, and you've got a trade surplus. Buy more than you sell, and you've got a trade deficit. Say a country exports 200 billion in goods but imports 250. That's a 50 billion trade deficit. And currency ties right back in. A strong currency makes imports cheap, so you buy more from abroad, widening a deficit. A weak currency makes your exports a bargain, which can shrink it. Here's where most people get it wrong. A trade deficit is not automatically bad, and a surplus is not automatically good. The United States runs a big, permanent trade deficit, and yet the world keeps pouring investment into it because it's seen as the safest place to park money. Meanwhile, a country can run a proud surplus and still be struggling at home with weak demand and high unemployment. What matters isn't the sign, plus or minus. It's why the gap exists and how it's being paid for. That investment pouring across borders has a name: capital flows. Money is restless. It's always hunting for two things. First, returns. If country A pays 6% on its bonds and country B pays 1, money floods toward A for the bigger payout. Second, safety. The instant there's a war, a crisis, or runaway inflation somewhere, money sprints towards safe haven. The dollar, gold, the bonds of rock solid countries. So, capital flows chase profit on a good day and protection on a scary one. And when foreign money flows into a country and stays, building factories, buying its bonds, that's basically the world voting. We trust this place. When that money turns around and sprints for the exits, that vote of confidence just flipped, and that reversal can crash a currency in days. Now, the scary word: debt. But not all debt is equal. There's domestic debt, money a government borrows from its own people in its own currency. And there's foreign debt, borrowed from abroad, often in someone else's currency, like dollars. And that is the dangerous one, because if a country earns its money in its own currency, but owes its debt in dollars, and its currency weakens, that debt suddenly costs way more to pay back. The hole digs itself deeper. So, when is debt actually a problem? Not just when it's big, and when it's unsustainable. Debt is sustainable if a country can comfortably keep paying the interest without borrowing more just to cover the old loans. A country can carry a mountain of debt and be totally fine if it's growing fast and earning plenty. But watch this. If an economy grows at 2% a year while paying 8% interest on its debt, the debt is growing 4 times faster than the economy. That math doesn't end well. That's the road to a crisis, which is exactly what country risk measures: the odds a country can't pay what it owes. And investors price it with one beautiful number: the risk premium. It's the extra interest they demand to lend to a shakier country versus a rock solid one. If a super safe government pays 3% and a riskier one has to pay 8, that 5% gap is the fear, written as a number, and it feeds on itself. The riskier you look, the more interest you're forced to pay, which makes you riskier still. A confidence problem can become a math problem terrifyingly fast. So step back and look at the whole web. Currencies set by confidence, trade flowing along who's best at what, capital sprinting toward returns and away from fear, debt that's either a tool or a trap depending on the math. It feels distant, but it's in your life every single day. The price of your imported phone, the cost of your trip abroad, the strength of your job's industry, and the returns on anything you invest globally. You don't control these tides, but once you can see them, you stop being surprised when they move. That's part two: the whole planet's money, one page. Put part one and part two together, and you understand the economy, top to bottom, better than almost anyone in your feed. Quick question: drop a comment. Should part three be how recessions really start, or how a currency totally collapses? I read every single comment. And if you're ready to actually put this into action, I've left two of my favorite tools in the channel description below. The first is Drawn to Wealth, our complete index fund investing tool. It takes you by the hand and shows you exactly how to invest in index funds the right way, the simple way, without the jargon. And it comes with an incredible bonus that reveals how to diversify your index investing, so your money is spread smart and working its absolute hardest for you. The second is the Stick Budget System, a beautifully simple plug and play tool that finally gets your finances in order and your savings growing on track automatically, month after month after month. And the best part, you can grab them both together for one discounted bundle price. It's all waiting for you right down in the description. Remember, the world's economies aren't separate machines. They're one giant web, and you're standing in it. Subscribe to Stick Market and draw your own path to financial freedom, one line at a time.